Hey guys, welcome back to a brand new video. I'm RexFinance, and if you've been following my channel at all over the past couple of weeks, you would know that I am very bullish on high growth, small cap stocks in particular. And I know that might sound crazy to some of you, but hear me out. I'll break it down for you really quickly. The first reason is because, well, small cap valuations are at historical lows right now. We've only seen valuations on small caps this low 2 times over the past 23 years. The most recent time was during the COVID crash of 2020, when the whole global economy was on the brink of collapse and shutdown. And then the other time was in 2008 and 2009, when the entire financial system was on the brink of collapse and shutdown. I, for one, I don't know about you guys, don't believe that this time in 2022 is equivalent in any matter of fact to those other 2 times over the past 23 years. And as a result of that, I feel that small cap companies in particular have reached very unfair valuations. Now, there's some other things we can look at. We also have the fact that small cap stocks have only returned 33.5% over the past 5 years. In comparison, the S&P 500 has returned 66%, double that of small caps, and the NASDAQ has returned over 120% over the past 5 years. Almost 4x the return of small cap stocks. So the simple fact that the Russell 2000 has only returned investors 33.5% over the past 5 years means there's more than likely some catching up in a day of reckoning coming for small cap stocks, where they will catch back up in performance. And lastly, the other reason I feel small cap companies are bound to outperform at least over the next month and a half is because we have interest rate clarity in the economy. We had a Fed meeting in January, March, May, June, July, but we don't have one in August, and the next Fed meeting we have is actually in September. So the next chance that the Fed has to raise interest rates is on September 20th and September 21st. The markets won't get that news until the 21st. So over the next month and basically 3 weeks, the economy and the markets know exactly what the federal funds rate is going to be. That clarity is huge for small cap companies because small cap companies tend to be the companies that are strapped the most for cash. They're in need of cash the most to grow their business, to invest in their business, etc. Because most of them are not cash flow positive. And that's one of the risks here. But that's also why the market has already priced in disaster for small cap stocks. They've seen this. They know this. Smart money is not dumb. They know that interest rates going up are bad for small cap stocks, exponentially more than they are for large cap and mid cap companies that are well established. But to put it simply, because the markets now know what the federal funds rate is for the next month and a half at least, I believe that more and more money is going to start to flow back into small caps, especially if we continue to see inflation go down. And because of all of those reasons in particular, I believe there are tremendous buying opportunities across the board with small caps. But we also need to cover the downside. We need to cover what stocks we should probably be staying away from. Because a market that was down by more than 30% at one point has undoubtedly caused some irreparable damage to a lot of stocks regardless of their future growth potential. And that's what I'll be breaking down in this video. But if you want an idea of a couple of small cap high growth stocks that I have been targeting in particular, go watch my most recent video by hitting the eye in the top right hand corner. Also leave a link to that video down in the description below. But without further ado, let's go ahead and jump into this. To really break down what we need to avoid buying in this market, I'm actually going to use a stock that I own. I've called this particular stock 728% undervalued on one occasion, and another occasion I called this stock 734% undervalued. And this stock that I'm talking about is obviously Shift Technologies, ticker symbol SFT. This stock is what I fear to be an example of irreparable damage that the market has caused to a company. Shift Technologies has been downtrending in share price for over a year now, basically to nothingness. And this is really confusing to a lot of people because Shift Technologies is just an $85 million company at its current market cap. And this year in 2022, they're set to do over $1 billion in revenue. You heard that right. $85 million for a company that is set to do over $1 billion in revenue. It sounds like an absolute steal deal on paper. And if this was a private company, people would be scooping up this valuation like no other. But because this is a public company, this stock and this company continues to get punished. And this is why. Shift Technologies has $95 million in cash on their balance sheet, which obviously is more than their current market cap of $85 million. But if you look, they have $272 million in debt. And to put sugar on top of this, the company has shown no evidence that they can ever reach profitability for shareholders. And that obviously is a problem. Now, this wouldn't be such a problem if we were in a bull market and the share price of Shift Technologies wasn't $1.07. But because Shift Technologies already has nearly 3 times their amount of cash on hand in debt, that means that this company can no longer access the debt markets. They can no longer leverage their balance sheet and their assets to take on more debt to grow the company. So they're left with one option, and that is diluting shareholders, selling more stock to the public markets to raise money, to invest in their company and grow their business. And this $95 million in cash is really only enough for this company to get through 2 or 3 quarters at best without having to raise funds. So at some point in time, this company is going to need an infusion of cash. And we've already covered that is going to have to come from the equity markets if they can't improve their balance sheet. But the problem is with the company trading at $1.07, one, they're at risk of being delisted from the NASDAQ, which would hurt their opportunities and chances of raising any money from the equity markets. But 2, more than likely, this company is going to reverse split their stock, decrease their outstanding share count so that they can stay listed on the NASDAQ as they raise their share price, but then in turn dilute shareholders even more and sell more shares to the public markets. This is what I like to call the dilution death spiral of companies. And this is really unfortunate. Because again, if we were in a healthy bull market, Shift Technologies would be a screaming buy right now because there would be no risk of Shift delisting. There would be no risk of Shift not being able to raise enough funds by selling more stock in the public markets. And not even to mention, if the management team did decide to sell additional shares at just an 85 million market cap, they're selling stock in their company at significant discounts, which hurts all shareholders and makes absolutely no sense. I've been a victim of this in 3 different stocks in the past when I first started investing in 2017 and 2018. Those 3 companies were Riot Blockchain, High Crush Limited Partners, and Chesapeake Energy Corporation. 2 out of those 3 stocks went bankrupt because they entered this dilution death spiral, where they would reverse split the stock and then sell more stock on the open markets, diluting my ownership in that company to a point where they couldn't sell any more stock, they couldn't take out any more debt, and they had to go bankrupt. Another one that has actively done this, and it's a stock that I've owned in the past, but I sold out of because I recognized that this was happening, is Gevo. Ticker symbol GEVO. That management team's favorite strategy is to reverse split the stock, sell more stock, reverse split the stock again, sell more stock, and the cycle goes on and on and on as the shareholder loses more and more value because their market cap keeps sinking further and further and further. And at a certain point, if a company's market cap falls far enough, they can also be delisted for that. It doesn't have to be the share price. It can be the market cap of the company. But this is why, although I am extremely bullish on high growth small cap stocks right now, I'm being extremely picky with the stocks I am buying. I am buying balance sheets that are extremely healthy. I'm buying companies that have horribly low valuations that are set to be cash flow positive in the short term to eliminate this risk of the dilution death spiral. Again, if you want a couple examples of stocks I'm buying, go check out my latest video. Another company that I fear this is going to happen to is Fubo TV, ticker symbol FUBO. There's a good chance all of you are familiar with this company. This stock is down to $2.50, and again, their balance sheet is nothing special. It's kind of concerning. They have $451 million in cash and $444 million in debt. At a minimum, you want a company to have more cash than they have debt, but even when it's 50-50 like this company is here, I'm still concerned because Fubo TV is burning cash. They're nowhere near profitability, so they need a cash infusion from somewhere, which based on their quarterly cash burn, along with the fact they already have over $400 million in debt, is going to have to come from equity. But their stock price is only $2.50. Again, in a good bull market, this might be a screaming buy opportunity, but right now it certainly is not, in my personal opinion. Now, that's not to say that I am unwilling to own a risky investment like this. I already mentioned that I still own a few shares of Shift Technologies. Nowhere near the amount I used to own, but I do still own a few shares of Shift. And this is why. Over the past month and a half, this stock has already returned 75% from its lows. That sort of return you can't find basically anywhere else in the stock market. So the potential rewards here with investing in companies like this is pretty much as high as you can get, but the risk also is pretty much as high as you can get, which is why I don't think you should put all your cookies in companies like this, maybe a very small percentage of your portfolio, because the bottom line is there are stocks out there that have similar reward opportunities as these companies like Shift and Fubo have, with significantly less risk. Companies that have been beaten up and their valuations are almost as disrespectful as Shift's and Fubo's, but their balance sheets are much more healthy, and they're looking at cash flow positivity sometime over the next 2 years. Those are the stocks that I want to target in this market. It's not going to be easy. I'm doing my best. I will get things wrong, but if you want to follow along, be sure you subscribe down below. Also, if you want me to look at any small cap or high growth stock in particular for you individually, join my membership down below. I'd be glad to do that for you in that case. With that, I hope you have a great rest of your day. Stay blessed. Peace out.